Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time homebuyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddie Cocciolo.
Good day, folks. Welcome to May's In Conversation with, and as you can tell from my hair, I'm not Eddie Cocciolo. I'm Greg Domville, the Vice President of Dominion Lending Centres, and I'll be stepping in on behalf of Eddie today. We have a lot to talk about with this morning's Bank of Canada meeting. Good news is the Bank of Canada has decided to not raise the overnight rate, but they held it steady without a decrease as we kind of predicted. So always glass half full. Rates have not gone up, but they didn't go down. They're staying steady, Eddie, unchanged, coming after 7 rate changes in the last 7 meetings. So lots to talk about today. But after today's meeting, we have lots of good news to comment on. Of course, again, the rates have held strong versus increasing. The GDP report came in a little bit stronger than predicted. The stock markets have recovered a little bit since the last meeting. What else are we going to talk about? Inflation is still kind of creeping up, but as inflation does tick up, that could benefit the mortgage rate industry in Canada by maybe some reduced rates down the road. So lots of going on. The tariff game is still a moving target. So the Canadian elections are behind us. So as I said a few times, we have a lot to talk about today in conversation with our very own Dominion Lending Centres chief economist, Dr. Sherry Cooper.
Hi, Greg.
How you doing, Sherry?
Very well, thank you. And you?
Well, very well to hear you're very well, considering what a crazy meeting it was this morning. And of course, lots to talk about. And I'm sure you've been tweaking your communications quite a lot since the meeting this morning, as I think some changes happened since what we predicted. So glad that you're doing well. And as always, we just wanted to recap what's going on in the Canadian world of the economics, what happened with the overnight rate, and everything has to do with Bank of Canada and Canadian economics. So what is your kind of feeling on this morning's announcement? Are you surprised by it? Because I know there was a prediction.
This is exactly what we expected. We expected them to remain on the sidelines once we saw the first quarter GDP figures, which were somewhat stronger than expected, largely as a result of front-running tariffs. Canadian exports surged. But this is, as you said, after 7 rate cuts, we've now seen 2 meetings where the Bank of Canada remained on the sidelines. And as I go through my presentation, I'll show you why I think that rate cuts are still in play for later this year. And as well, we certainly had major uncertainty. And now today, effective today, we've got a doubling of the tariffs on aluminum and steel, which is the equivalent of a blockade, because there won't be any trade in that sector between Canada and the US if those tariffs remain.
Well, I'm pleased that they held the rates steady, at least for now. I think there's a lot more information to gather and a lot more information to see what's going to be happening before they decide to make some more rate cuts. But I agree with you, Sherry, that I think inevitable the overnight rate is going to drop later on in this year. But with the historical amount of refinances and renewals that we have upon us in Canada, I still think it's a pretty strong time to talk to our mortgage professionals here at Dominion Lending Centers, and for us to talk to our clients and just have a conversation with consumers to see how you're feeling, and talk about the renewals that are upon us, particularly with the fixed rates creeping up slowly. Variable rates are still a strong opportunity. So opportunities of lots of renewals upon us, but let's see what happens over the next few months with the housing market, and with more information gathered if rates are going to drop as predicted later on this year. I will make a note for our audience: if you do have any questions or comments you do want to post for us to comment on the air here, please put it in the comments, and we'll keep our eye on any questions that pop up. And at the end of the presentation of Dr. Sherry Cooper, I'll address those questions in front of Sherry. So let's get started, Sherry. I'm really curious to see what you have to say in regards to this morning's meeting.
Great. Okay. Well, here you go. As always, lots of uncertainty and lots of developments. There are many aspects about what's happening in the global economy right now that are truly without precedent. So if you're feeling uneasy and less certain than usual, you're in very good company, because everyone everywhere is in the same boat. As I mentioned, we saw that Trump announced late last week that he would double the tariffs on steel and aluminum from 25% to 50%. So par for the course. Again, like big changes with very little consultation, or for that matter, any kind of research underpinning or analytical reasoning that makes some sense. So let's just start from the fact that we've got a U.S. power base that is seeming to enjoy the chaos, and it's unlikely that there will be any sort of final plan on the tariff front anytime very soon. Trump has made it clear that there are 5 areas of the economy that he is very interested in seeing what he considers to be a major improvement. The tax cuts, he wants to extend the tax cuts that were introduced in 2017. In fact, he is adding to them what he calls the big, beautiful bill, has now completed the House of Representatives and has moved on to the Senate. We'll see what the Senate does with this. Now, the Republicans only have a 3-vote majority in the Senate, so that's extremely thin, especially since we know that 2 Republican senators led by Rand Paul have decided already that they will vote against the big, beautiful bill. And Elon Musk today said that that big, beautiful bill is a catastrophe, which I tend to agree with. It will increase the U.S. federal budget deficit by an estimated $3 trillion, bringing it to a record high level vis-a-vis, relative to the size of the economy. The U.S., we saw the downgrade from Moody's just a couple of weeks ago. So further risk on the U.S. front. Tariff story is far from over. Right now, we're at the stage where many European and other countries are proposing, making their best offer, as Trump says, to him, and in the hopes of avoiding large tariffs. We see as well continued trouble on the legal side. There are judges that have said the tariffs are illegal, other judges that have allowed the restraining order to be removed for the moment, but still very uncertain. The same is true on the immigration side, and the deportation isn't going as quickly as Trump would like to see it. Deregulation as well, another big force in the Trump administration. We've seen Musk go through what was called Doge. That was a big, horrible mess. And there is waste and fraud, but mostly there's just excessive government spending. And in the face of what Trump wants in terms of tax reductions, particularly for wealthier people, none of that plays well in financial markets. So just to put the global picture in perspective, I wanted to highlight once again just how important Mexico and Canada, and then to a much lesser degree Vietnam, is in terms of US trade. Mexico, Canada, Vietnam, Brazil for food. These are the countries that have the largest trade balances with the United States, where these are ranked by exposure of exports to the US. And we also see why Canada is so important in all of this. Canada is the second largest trading partner of the US and the number one market for all US goods and service exports. I'm not sure that Canadians appreciate that fact, that there's no other country that buys more from the United States than Canada. And we have the second lowest trade deficit in goods and services with the US. So why is the US picking on us? I mean, picking on us is really the only thing I can say about it. If you were to exclude energy exports to the US, which the US considers to be critical, the America would have a trade surplus with Canada. Trump's the driving force here seems to be that Trump wants to see the US having trade surpluses with everyone, and as well for the US to bring back manufacturing. Now, it's one thing to talk about wanting to be the global leader in new industry sectors, new kinds of manufacturing, or artificial intelligence, or nanotechnology, or other leading edge new developments. The US has been at the leading edge in terms of medical research as well, and Trump is destroying that by cutting federal grants and programs and attacking some of the major universities in the United States. So, much of what he's doing will be counterproductive. It's very unlikely that we will see products produced in the US that have long been produced elsewhere, mainly in China, but also in Vietnam, in India, and other countries with low wage rates. Well, let's look also at the specifics for steel and aluminum, which loom so large. As you see here, nothing compares to Canada in terms of the dominance of exports of steel and aluminum to the United States. The reason Canada can cheaply, economically export so much steel and aluminum to the US's advantage, is because hydroelectric power is so much cheaper in the US than it is so much cheaper in Canada than it is in the US. Think of Montreal, think of Quebec as a whole. It's the home of aluminum for Canada. And hydroelectric power, which we do sell to some American states like New York and Michigan. This aluminum takes a lot of energy to produce, and we can do it effectively, cost effectively. So we are by far the largest trading partner with the United States in this 50% tariff world. Canada is much more dependent on trade than the US. Now, I've said this many times, but I just want to put the numbers here so you can see that the exports of goods and services relative to the size of the economy is 34%, compared to a mere 11% in the US. In other words, we have a large open economy where trade is very important. The United States has a much larger closed economy where trade indeed is a very small proportion of overall economic activity. So Canada has long been dependent on the US. The US is the export destination for nearly 80%, 77% of Canadian goods traded. And no other country accounts for greater than 5% of Canadian export volume. So you've got the US, which buys almost 80% of our exports, and then the next down would be the 5%, which is trade with the UK. Very, very big gap there. But the US is also dependent on Canada. Canada is the largest export destination for US goods, representing 18% of US exports, followed by the 16% in Mexico and only 7% to China. China, of course, is a major factor in these trade negotiations. Now, the auto sector is particularly important because the free trade agreement, the US-Mexico-Canada Free Trade Agreement, which was in fact signed into law in the first Trump administration, and Trump very much supported it. Much of it involves the auto sector, where automobiles produced by many countries, but most prominently US auto manufacturers, move across the two different borders between the US and Canada, the US and Mexico, back and forth as cars are produced. If we were to see the goal that Trump is trying to achieve, the full onshoring of all non-US auto production, it would require a 75% boost in US auto production and $50 billion in new factories. This would significantly decrease the profitability of US auto companies. And those auto companies have been very vocal in lobbying the executive in Washington about these facts. Another thing that's happening, and this is really interesting, is that we're beginning to see China shifting its oil purchases from the US directly to Canada. And that you see that in this chart here. Early days, I'm not suggesting this is going to carry on forever, but I do think that this is one of the unintended consequences of Trump's tariff war. So it looks like rather than the soft landing that we had been predicting prior to the election in the US, we're now going to see a hard landing. Not terrible, but still not what we'd like to see. The OECD presented its forecast for the Canadian economy in the last couple of days, and they're forecasting that GDP in Canada will be about 1% this year, 1% growth this year and next year. I think that we might see a bit more strength than that. I'm forecasting 1.2%, but it looks to me like we've got a mild recession that's already begun. It's not 100% for sure. We saw that 2.2% growth in the first quarter, which was surprisingly strong, but it was the direct result of a surge in Canadian exports to the US in advance of tariffs. And that, of course, is not sustainable. We think the growth will be more like a contraction of about a 0.5 percentage point in the second and third quarters, which will lead to the Bank of Canada's reconsideration, cutting interest rates, but they will cut interest rates just another 25 to 50 basis points, 50 more likely, over the next, call it 3, 4, 5 months. Certainly before the end of the year, we will see another rate cut, assuming that inflation remains under control and that inflation expectations are muted. Now, that's a big if, and that's why we have a good deal of uncertainty here. The US economy has been more resilient, much stronger than Canada, but that's because Canada is far more interest rate sensitive than the US. And what I want to show you here is what's happening across the yield curve. This looks at US interest rates, and you see that year to date, we've seen the 2-year yield, 5-year yield, and the 10-year yields falling year to date, but the 30-year government, US government treasury bond yield is still up on the year to date. This is because of great concern about the size of the US federal deficit. Moody's just a week ago downgraded the US government debt. US, of course, is the reserve currency, and as a direct result, it is foreigners own US treasuries. Now, this shows you how 30-year yields have risen, not just in the United States, but literally everywhere in the world, and including Canada. We've seen an uptick in the longest end of the yield curve, again, because of rising budget deficits. And this shows you now, this looks at foreign holdings of US Treasury securities. The black line is China, and you see, once upon a time, earlier in the 2010 to 2020 period, China was the largest foreign owner of US government securities. That has changed, and China, in fact, has reduced its holdings of US treasuries. When they sell US government bonds, that leads to a decline in the bond price, which means, by definition, higher interest rates. In other words, the government of the United States needs to pay more to entice investors into their government bonds because of the risk associated with very large budget deficits. What we see is China has sold US treasuries on balance in the most recent few years, and now Japan is the #1 holder of US treasuries, and China has moved below the UK. So the UK is the second largest holder of US governments. Now, this shows you the US federal deficit to GDP ratio and compares it to that in Canada. The first chart looks at Canada's in the blue here, and the US that is an unbelievable increase in the federal government gross debt in the US, and far bigger than in Canada, where at least since about 2009, it's been pretty flat, except in the most recent period. The right hand looks at the US federal debt as a share of the economy under different scenarios. There's no question that this bill that's in Congress that will come out of committee or conference in the Senate and then be negotiated between the House and the Senate, that it will be changed. And it can't really remain at these levels. It's just not prudent for the US to be gunning the engines this aggressively at a time when inflation is under upward pressure because of tariffs. Now, there's been also lots of change in terms of the way potential buyers or first-time buyers are looking at the decision between fixed versus variable. We saw that variable loans were very popular over the course of the last decade, just until we moved into the more recent last few years. So when we had the boom in housing in the early 2020s, as a direct result of very low interest rates, much of the mortgage debt that was originated over that period was in variable loans. Not so much anymore. And in fact, fixed mortgage rates are rising as lenders, especially the big six banks, retreat from aggressive pricing. So it is not clear that variable rates, though they may be lower than fixed rates at some part of the curve, it's still not clear that a variable loan is the prudent step for those people who believe they'll be in their home, the home they're purchasing, for the 5-year term of their loan. And also, there is too much of a risk that longer term interest rates will be rising for those who are risk averse, to want to forego the certainty of, let's say, a 3-year fixed mortgage, or at the very least a hybrid mortgage. So the big 6 Canadian banks as of this week are no longer marketing sub 4% mortgage rates. The share of prime broker customers who chose floating rates fell to under 30% in May, to 27.8% specifically in May, compared to just over 29% in April. So people are risk averse, people are nervous, and for good reason, given all that's going on in the economy. Canada, therefore, is far more risk interest sensitive than the US. You can see, looking at mortgage debt servicing relative to household disposable income, that's the after-tax income. You can see that mortgages loom much larger in Canada relative to income than they do in the US, because in the US, you can lock in a 30-year fixed rate mortgage loan. We know that, but it shows you, therefore, how crucial it is in terms of what the Bank of Canada does or does not do in the face of a weakening economy. Now, nowhere do you see the Canadian weakness than in the labor markets. The unemployment rate has moved up to 6.9% as of April data. But over the last decade, our unemployment rate has averaged 6.8%. So this is high, but it's not high enough to warrant the vacuum in housing activity that has developed in many parts of the country, particularly in the GTA and especially in the condo sector. What we can see is, looking at job growth, for the month of April, we had a very weak job number in April, and we saw that the unemployment rate did tick upward to 6.9% from 6.7% in March. Now, the May employment numbers come out this Friday, and we'll also see the June numbers before the next Bank of Canada decision date on July 30th. So lots more fodder for the bank to cogitate before they make their decision. But clearly, the labor markets are feeling the pinch. This shows you a comparison of our 6.9% unemployment rate to the US's 4.2%. Now, if you were to compare apples to apples in terms of measurement, Technology, the two numbers would be closer together, but still, the Canadian economy has weakened substantially more than the US economy. So when asked, when the Bank of Canada does its survey of consumer expectations, one of the questions is the probability of losing a job over the next 12 months. And you see in the latest reading by the Bank of Canada that that projection has surged as more people expect to lose jobs and as more sectors, generally those hit hard by trade, are already introducing substantial layoffs. One piece of good news is we've seen a continuing of the downtrend in wage inflation. Inflation, in fact, the headline inflation numbers were very good for the month of April. They fell 1.7% below the Bank of Canada's 2% target for inflation. This lower headline inflation was the result of the end of the consumer carbon tax and as well falling energy prices. So Canadian headline inflation decelerated from 2.3% in March to 1.7% in April. But when you look at the favored core measures of inflation, those have been heading higher, and both measures favored by the Bank of Canada are now above 3%. Not a reason for the Bank of Canada to tighten monetary policy, certainly, but a reason why the bank is on the sidelines right now. This shows you the 3-month moving average in core inflation. And again, all the measures are trending higher, the direct result of the tariffs. The breadth of inflation had declined very sharply until late last year, and then with the inauguration and the announcement of tariffs, the breadth of inflation has widened. Inflation in excess of 3% is what this chart, what proportion of the goods and services purchased by the average household, the proportion of prices that have gone up by 3% or more has edged higher. And that's troubling to the bank as well. So the Bank of Canada did exactly what we thought they would do in holding the overnight rate steady. And the Bank of Canada's overnight rate remains then at 2.75%. On this chart, I show you the rate cuts and the rate policy, overnight policy rate of both the Federal Reserve and the Bank of Canada. And you see that Canada has eased monetary policy far more aggressively than the US, as our economy has weakened, because our economy is far more dependent on exports, and therefore tariffs have a much bigger impact on our economy than on the US economy. So central bank policies have diverged. Donald Trump doesn't like it. He's pressuring the Federal Reserve to cut rates more aggressively. The Fed wants to maintain its independence and won't do it. But right now, the spread between the two policy overnight rates, Canada's overnight rate is a whole 160 basis points lower than the US overnight federal funds rate. That is a monumental difference in policy stance in terms of monetary policy. This shows you the 5-year Government of Canada bond yield. It has trended upward in the most recent period, but at least it's fallen very recently to a little bit below where it was when the bank last met in April 16th. So we've got the 5-year yield up a bit. Now, this is a list of the decision dates that are coming. I think there's a good chance we could get another 25 basis point rate cut at the July 30 meeting, and maybe one more rate cut later this year, taking the overnight rate down to a 2.25% by the fall of 2025. And this, of course, is uncertain, but it would help to spur housing activity. Canadian home sales were unchanged on a national basis in April as new listings retrenched and home prices continued to fall. Now, we have some preliminary data for the month of May. So far, what we've seen is continued relatively weak stance for housing. Sales continue to fall year over year in May in Vancouver, Calgary, and Toronto. And hardest hit where continues to be the condo market, especially in Toronto. Now, this shows you the seasonal pattern of typical monthly share of home sales. And normally you get a big improvement over the course of the spring, peaking in May. But this spring, housing certainly missed its typical seasonal upswing. What we see here is you see that April home sales are markedly below the 10-year average, moving average for monthly home sales. And looking at it here, you see monthly home sales were unchanged in April due to tariff concerns. So this compares April to the average for the first quarter, January, February, and March. So a big dip in activity there. This is an interesting concept here. Gross debt servicing ratios have actually declined. They are at a 2-year low. This is an estimate made by, let me go back to it, by Mortgage Logic News, which is Rob, oh God, his name just dropped out of my head, McLister. He did this work. What he's doing is he created an aggregate GDS calculation, which is based on the Real Estate Association's average home price, StatsCan's average dual wage household income, and the federal minimum qualifying rate and the standard measures for property taxes and heat and condo fees that are included in the GDS ratio. It has come down for 2 years as a direct result of both a decline in borrowing costs, but also a rise in household income. So affordability has improved, but housing activity has plunged, which is not sustainable. If that's a very unusual situation, one that very much reflects how unusual this tariff war is and what a big effect it's having on housing. New listings fell 1% in April, but the May preliminary data suggests that new listings increased sharply in May. When you look at sales to new listings, that ratio continues to fall. In many parts of the country, we see that this is a buyer's market. A lot of inventory of unsold properties, mortgage rates below where they've been, and lots of motivated sellers out there. So it's a good time for first-time home buyers, and they are moving back into the market. But again, with all this uncertainty, it's not surprising at this point in time, activity does remain quite muted. This shows you the national home prices. This is the home price index benchmark price that has trended down very dramatically since 2022. And you see the delinquency rates on mortgages, those are increasing. This shows you percent in arrears and the number of mortgages in arrears. In both cases, the numbers have risen, but by historical standards, they still remain quite low. And then finally, the other factor that has a big effect on housing, both rental and for purchase, is immigration and, in fact, actually population growth. The government did slam the brakes on immigration in the last several months, and we've seen that come through already. The population growth is slowing. It was at 1.8% population growth in the fourth quarter of last year, which is the slowest in 2.5 years. And as we move through this year, that number is likely to fall further. These are our estimates of where the population growth will be. You see far, far less. So therefore, demand for housing does slow, which will be another factor contributing to the sustainability of what could be a real rally in activity as the year progresses, particularly if we get some clarity on tariffs and the Bank of Canada begins to ease monetary policy again. Slower population growth reduces economic growth and inflation, all other things equal, and that's consistent with lower interest rates. So that completes my formal remarks, Greg, and now I'm happy to open this up for questions or comments.
Thanks so much. That was, like I said, a lot to talk about from the June 4th meeting this morning. It spurred on a lot of questions, and we do have some questions we're going to go through. I have some of my own, but just to remind our audience, if you do want to table any questions in front of Dr. Sherry Cooper, just throw them into the comments there, and we'll table them. Again, lots of uncertainty. We heard that word a lot, unprecedented, and lots of uncertainty. But I want to focus again on there's lots of positives as well for the mortgage market, and again, to have a rate remain solid versus going up is a positive, coming off of 7 decreases, with the forecast that we probably are going to see some more rate decreases in the variable product by the end of the year. Again, I'm going to repeat that the GDP report came in a little bit higher than predicted. Again, I think that's a positive. The stock markets have recovered their losses to somewhat degree. And I was really interested in what you were saying, that the GDS has lowered in the last 2 years because of, average household incomes increase. So that does support the concept that affordability is there, which spurs on the concept of, if you're a first-time buyer, this potentially could be a good time to buy because of the affordability is there, your affordability to qualify is there, and prices are not rising too high yet. So this is a positive for first-time homeowners or first-time buyers. I really want to focus on that. And I'm going to say it again as well, with the historical amount of renewals that we have, and if you're coming off of a low interest rate that you had before and you're coming up for renewals, like, really encourage us to speak to our network of mortgage professionals, because you do have options. You have options by shopping your mortgage to different lending opportunities. You have options between fixed versus variable, and there's no perfect answer. There's not one size that fits all. Everyone has their own certain risk tolerances. So talk to your mortgage professional at Dominion Lending Centers to really focus on what your options are when it comes to these renewals. And once again, if you're a first-time buyer, my comment is I think it's a good time to buy. So I do have a couple of my personal questions, but I do want to focus on our audience's questions. So one question came in that I also wanted to comment on. Why? So my question was this, but then you answered it. Why is Canada more interest rate sensitive than the US? And you did comment on that. It's because of the States has a more prevalent 30-year amortization. So with us not having a 30-year amortization, we're more rate sensitive because of
it's not just 30-year amortization. They have 30-year maturities on their loans. And so, theoretically, your monthly mortgage payment could be fixed for 30 years.
30 years.
That can't happen in Canada. In addition,
sorry, go ahead.
In addition, mortgage interest and property taxes are tax deductible. Now, the property tax deduction is income or needs-based. So if you're a high income earner, you won't get much of a write-off for that. But mortgage interest is tax deductible. That makes housing so inexpensive in comparison to Canada. And one of the questions in the comments is, well, why don't we have 30-year loans? And the reason is because it is extremely expensive for the governments to subsidize housing, and the US is unique in this regard.
Interesting, because that was the comment that I was going to table from Nina, that you read it as well, as if the 30-year in the States, why doesn't that exist in Canada? Just because of the expense you just commented on, right?
Yes. Yes.
So another question that I personally had was, with Canada being US's #1 customer, why are they picking on us so much? Like, if we stop sending them aluminum and steel because there's tariff the heck out of it, what's their option? Are they going to build steel and aluminum plants in US? And what's our option then? Do we have other?
That's what Trump would like to see. And
Right.
Part of this has to do with the US steel purchase by the Japanese company, Nomura. So, Trump's trying to unlevel the playing field. He wants an advantage to bring home, to onshore all manufacturing activity. Apple is a great example of this conundrum. All of Apple's assembly and production does not occur in the US. It occurs mostly in China. Mm-hmm. Apple wants to move it from China to India in compliance with Trump, but India is not moving, isn't the US. It would be prohibitively expensive to produce the iPhone and the other Apple products in the US. It would put Apple at a huge competitive disadvantage. So they're not doing it, and they're not bringing it back to the US, and Trump and Tim Cook are having a big argument about that. But it's just not realistic, and trade is a good thing, not a bad thing. If we didn't have trade, we'd never have avocados, as one example. And it's a great example, because the truth of the matter is we couldn't produce avocados in the quantity that we would demand, even if we were to create these hothouses to do it. And all of our avocados are imported from Mexico. So the whole free trade movement, which began way back with the automobile pact between Canada and the US in the 80s. I mean, this was a win-win for both countries, and certainly it's been a big win for Mexico as well. Now, Carney and Trump and Mexico will renegotiate the free trade agreement, but nobody knows when, and nobody knows what the ultimate result will be.
Agreed. Let me table a question from Azim, one of our mortgage professionals here. JP Morgan's Jamie Dimon recently said that the bond market will crack. Sherry, do you agree with this? And what does this mean for the Canadian bond market?
Well, Dimon is pointing to the big, beautiful bill of Donald Trump's that has gone to the Senate. And there's no question that the bond market is in a precarious position in the US. And we'll see what happens with this bill. If it were to go through as is, which it won't, but if it did, I think we could see higher long-term interest rates a year from now than we've got right now. If
higher,
right?
Fixed, like 5-year term fixed rates.
No, I'm talking about just the U.S. If this bill goes through, the U.S. long-term interest rates will be higher than they are right now. And Canada's rates will be higher than they are right now, which will be devastating for our economy.
Hence, the big beautiful bill isn't too beautiful.
It's not. It is unaffordable. The U.S. The ratio of the U.S. deficit to GDP is bordering on 200%.
But I think I just heard you say that you don't believe that bill is going to pass.
That is, if something will pass,
right?
And the deficit will be bigger than otherwise as a result. I just don't think it will be as dramatic as what we've got right now. But let's hope, because we don't know.
We don't know. Jay Nugent's asking a question. So we are facing a recession with potential higher fixed rates. Is there much that the Bank of Canada can do to help?
Well, they could lower short-term interest rates, but they have a policy of targeting inflation at 2%. Well, inflation, at least core inflation, is over 3%. So they are not reducing interest rates right now. Whether or not they do so in the future will depend largely on the data that come in between now and their next decision date on July 30th. What we're likely to see, we're going to see 2 labor market reports and 2 inflation reports between now and then. And so it really is real-time forecasting in that I don't know what those 4 reports are going to show. What I would expect is we'll see further weakening in the labor markets and some uptick in inflation. The sum is what's crucial. If we get some softening in the core inflation numbers and a weakness in labor, the Bank of Canada will cut rates. And that'll be helpful across the mortgage space.
Yeah, as you said in your presentation, we're predicting that we'll see potentially a quarter point drop in July and then another quarter point drop in the fall. So, that could be Bank of Canada, or that will be Bank of Canada's efforts to try to help the affordability by dropping those rates. And if we can get a 0.5 point reduction over the next few months, that'll be a big help to the Canadian mortgage market for sure. So you talked about forecasting. I'm going to put you on the spot here. From Chris Murphy's asking, please try to predict where the 10-year U.S. bonds will be in the next 12 months.
Yeah, right. You know that nobody can do this. Like, no one knows.
Right.
I'm hoping they'll be lower than where they are now, but I don't think there's a high probability of that. I think we're trading in a range, and the yield curve is steepening so that the shorter term interest rates will come down, but longer term rates will remain high as a direct result of these budget deficits and huge debt loads.
Watching the clock here, we got a few minutes left. I'm going to table a few more of our questions from an audience. This guy never misses any of our shows here. Mortgages by Mark. He's asking, does the rate cutting cycle have any resemblance to the 2000 and 2008 rate cutting cycles, specifically where the overnight rate lowered quite a bit more than the 5-year bond?
Right. I don't expect we're going to see the overnight rate down to where it was pre-COVID. Pre-COVID, the overnight rate was at 1.75%. Currently, it's at 2.75%. So even if we get the 50 basis point cut, it's still 2.25 above the 175 before. The reason rates are higher is because before COVID, the prior 10 years, average inflation was below 2%. Inflation, as a result of these tariffs, no question, is not going to be that low over the next year. And therefore, we're not going to see the kind of easing, aggressive easing that we've seen historically in the past. And they've proven that by just remaining on the sidelines 2 times in a row.
Yeah. And again, that's not necessarily a bad thing. I'd rather them stay the same versus going up. But I love the conversation that we potentially could see some more rate drops.
Well, there was never any chance that they were going to raise rates.
Right.
Never. Like that they are not going to raise rates until and unless inflation increases very sharply. And I don't see that happening. And there's just too much weakness underlying the global economy.
So let's do our last question from Josie. And this kind of speaks particularly to the mortgage industry. Do you foresee any further changes to the insured and the insurable mortgage rules from CMHC to support the housing industry?
I don't. Well, the only thing I see that might change from a regulatory perspective is OSFI might take back the minimum qualifying rate that's 200 basis points above the contract rate. There's been some talk that Peter Rutledge at OSFI believes that the new rules regarding the overall exposure of the federal financial institution's mortgage book relative to the ratio on the mortgage book of income to the mortgage amount, that ratio is now regulated, that banks have to, they can't hold large percentages of mortgages that the outstanding balance is very high, like 4 times or more income. And so given that the banks now are being monitored on that basis, it may be that OSFI doesn't feel the need to enforce that you qualify at, hundreds of basis points more than what you actually are paying.
Yeah, that's definitely a magic wand. We'd love OSFI to wave their wand and just fix this whole situation, but it's not quite that easy. So good question from Jose there. So there we go, Dr. Sherry Cooper. I really appreciate you spending an hour with us to help better educate our consumers, help to better educate our network of mortgage professionals. Don't forget the next meeting is July 30th. Cross our fingers, we'll see a 1/4 point drop then. Then September 17th and October 29th will be the next Bank of Canada meetings. Now is a better time, or the best time ever. If you're a Canadian consumer with a mortgage, contact one of our mortgage professionals at Dominion Lending Centers. You can find us at dominionlending.ca and find one of our experts to have a conversation with. Again, there's not one size that fits all. Are you a fixed rate consumer? Are you a variable rate consumer? There's an answer for both sides depending on your risk tolerance and what you think is going to be happening. Don't forget, if you're a first time buyer, give it some thought. Is the housing market going to increase in prices? It's a strong probability that's going to happen. So if you're on the cusp of, if you're on the sidelines of maybe purchasing your first home, now is a good time as well to contact one of our agents to talk about what that would look like. And the renewals. There is an historic amount of renewals. So it's our job at Dominion Lending Centers to talk to as many consumers as they can to remind them that you do have options. You don't just have to blindly sign that renewal agreement that's offered to you from your existing lender. Talk to us. Let's see what your renewal options are and get you into the best position so you have some certainty and as less risk as possible over the next few years. Dr. Sherry Cooper, thank you so very much. You're always so informative, such a wealth of knowledge, and you can summarize this crazy times in 1 hour. It's pretty impressive.
Thank you.
Thanks so much, folks. We'll see you next time in Conversation With on July 30th.
Bye-bye.
Bye.